Welcome into a daily editorial here on the KE Report. In this daily editorial, I am joined by Jordan Roy-Byrne. He is the founder and editor of thedailygold.com. And Jordan, I want to revisit a post that you put up at the turn of the new year, January 1st actually, that says 5 reasons gold stocks will break out in 2018. I will post a link to this article below this interview, but what I do want to focus on is some of the key points that stuck out to me. One being actually one of the bottom points that you made is increasing inflation expectations. We even heard that some of the Fed officials are expecting some more inflation to pick up, both on the heels of tax cuts and also because, you know what, even at the start of last year, 2017, we were having these increased inflation expectations and they didn't materialize. But we can look at such things as oil and copper that are showing, you know what, maybe we will have a bit more inflation. When we're talking about inflation, though, we're going to be focusing more on the bond market. First comment, though, Jordan, why, again, do you think inflation expectations are increasing, judging by what's going on in bonds?
Well, I think, for one, Corey, stepping back from bonds for a second, as you noted, there's some commodities. Copper's been very strong. Oil has been strong. The tax cuts are, those are going to go through. Those will increase inflation expectations. But, now they're starting to lay the groundwork for talking about infrastructure spending. And I mean, the tax cuts are really not going to help Trump's base that much. The real base that won him the election, which is lower middle class whites who have been really left behind in recent decades. And so it's infrastructure spending that's really going to help more of his base than tax cuts. And that's why they're moving on to that. And I mean, if you have these tax cuts and then you throw on infrastructure spending, I mean, of course, it would take a while to enact that into the money that spending to start happening. But markets discount things in advance, and you look at economic growth around the world has picked up. Growth in the U.S. has picked up a little bit. You see some commodity prices rising. You see what's happening politically, and then we get to the bond market, and you look at the 5-year bond price has already broken down to something like a 7 or 8 year low. So the 5-year bond yield has broken out to a multi-year high. And if we look at, the charts that I had in that article that you're referencing, I show the 5-year bond price, the 10-year bond price, and the 30-year bond price. And as I said, the 5-year bond price has already broken down. It's just broken down to its lowest level since it looks like the end of 2010, actually. And if you look at the 10-year bond price and the 30-year bond price, those, as far as a potential downside breakout, they haven't happened yet. They're lagging behind. So those bonds, as far as the bond prices, are less weak than the shorter term bonds because longer term bonds are more corresponded, I guess, to inflation expectations and the 2-year bond price or the 5-year bond price. So if you look at the 10-year bond price, Corey, it has a little bit of room from here and down to its 2014 low. And if it breaks below the 2014 low, then it's trading at the lowest level since it looks like the end of 2011. So the 10-year bond is very close to that kind of a breakdown. And then you can look at the 30-year bond price, which, it's not as weak as the others, but it is not that far from breaking below 2015 and 2016 lows. And so if it would break below that support, it would be at its lowest level since the very end of 2014. And so basically, if we get these breakdowns first in the 10-year bond price and then the 30-year bond price, those would definitely raise inflation expectations because, as I said, I mean, these long-term bond markets, they're much more corresponded to inflation and inflation expectations than the shorter-term bonds. And I mean, that's something we talked about at some point weeks ago or a month ago, where looking at the bond market, we were talking about how short-term yields were screaming higher, but longer-term yields were not. They were stable, kind of rising a little bit, not rising as fast. But if you get the 10-year bond and 30-year bond, breaking these support levels, and then of course those yields would be moving a lot higher. That is as far as the interest rates in the bond market. That's really what would be bullish for gold because it would raise inflation expectations. The bond market would be starting to price in inflation, and to go back to what I just said, the key for gold and precious metals is that you need to see weakness in these longer term bonds. I mean, we've seen a lot of weakness in the short term bonds, the 2-year bond, the 5-year bond. And so those yields, weakness in bonds means those yields have been rising. And again, the 10 and 30 year, those yields have kind of been stable, rising a little bit, but not as fast as the shorter term yields. And so again, if we get a big breakdown in the 10-year bond, that's with respect to the bond market, that's really what precious metals need, because that would raise inflation expectations. So we've seen it a little bit in the commodity markets, but not entirely. We haven't seen it in the bond market. And so again, we get a breakdown in long-term bond prices. That's going to raise inflation expectations. That would be a bullish catalyst for gold and precious metals.
Okay, so Jordan, I will post this one chart below this interview again for people just to refer to, but I do recommend clicking on that link and reading this full article. Again, talking about these bond prices, we can see how much they were collapsing throughout 2016 into, well, pretty much it looks like almost the beginning of 2017, but then we saw this short-term little bump. From a charting perspective, this short-term little bump after what looked like it was just going to break through this resistance, that has to, I think, give you more confidence that when we test this support zone again, most likely a breakdown will come. Is that correct?
Correct. And the rebound that we had in 2017, at the same time when gold was rebounding, I have the wrong moving average in that chart. But if you look at a 400-day moving average, which I like using in addition to the 200-day, the rally which peaked in, it looks like Q3 of 2017, it peaked right at a declining 400-day moving average. And since that peak, it's come back down to that support. So, and something else we were talking about beforehand we got on here, I was trying to explain to you the correlation. I mean, the last couple of years, we've known that there's been a strong correlation between gold and bonds, and that's because higher bonds, lower rates. That's positive for gold when you don't have that much inflation. You don't have that much inflation and rates going lower. That means real rates are going lower. So that's why you have that correlation. But on the other hand, real rates can also decline and be bullish for gold if you have inflation or inflation expectations really increasing faster than short-term rates. And so it's very interesting because if you look at the 10-year, you look at that chart of the 10-year bond price, I mean, that if that breaks down, you're talking about the lowest level since sometime in 2011. So you're talking about a 6-7 year low. I mean, that would be a very significant breakdown. And perhaps that breakdown could happen at the same time or around the same time as a big breakout in gold, breaking out of its 4 or 5 year bottoming formation. And, a couple of months ago, I would have said, no way. But now, because of the correlation, just in the last couple of months, the correlation has really started to flip. So in other words, gold right now is, in the last couple of months, it started to hold up much better and show more strength with long-term yields rising or long-term bond prices starting to weaken and fall. So again, this correlation has changed quite a bit in the last couple of months, but it's something to really keep an eye on. If we do see this big breakdown in the 10-year bond price, I mean, that's something that could, it looks like now it's much more likely to be a positive catalyst for gold than it was, 2-3 months ago.
Yeah, it's always important to look at not just one market, but understand some of the correlations that are at play at the current time and some that aren't at play. Because quite frankly, you need to understand too, I think, is that with longer term bonds and how big of a player central banks have been, if they start to wind back some of their monetary policy, then we could see a general shift from the last 10 years of what we've been seeing, this easy money around the world policy. And that has definitely helped support the lower interest rates and higher bond prices. If that all starts to turn, you know what, gold hasn't been impacted by this easy money at all. And maybe that easy money does start to flow into gold. But again, it's important to look at some historical patterns, especially recovery patterns in terms of if any sellers are left or if they have totally left the sector. You break this down too in terms of gold stocks on GDX and GDXJ. Can you share some of your findings and some of the correlations you're drawing to historical recoveries?
Yeah, well, that was a beautiful segue, Corey. But getting into the historical recoveries, I mean, this is something I wrote an article on this. I believe you posted it on your site, and I think we discussed this several weeks ago or even a month ago. It's just interesting how the recovery in the gold stocks since the end of the bear market has shown a lot of similarities to some other markets, which include Thailand in the late 90s, the Great Depression. Gosh, there's one other one that's slipping my mind. Housing stocks, after the global financial crisis. And so we're looking at what, how do markets recover after having a mega bear market, which would be, to me, is over an 80% decline, and then something that is over 2 years in terms of time. I mean, there's a lot of crashes, but there's not many crashes that last 3, 4, 5 years. And so if you look at these mega bear markets that last beyond a couple years, in many cases they follow this pattern where they have like a really strong rebound, as far as time, it doesn't last that long. And then the next correction and consolidation tends to last much longer than that first leg, and it tends to last at least 18 months and sometimes even longer. And then that leads to another leg higher. That's a real impulsive advance. Thailand, for example, its second leg corrected and consolidated by, I think, 50% or a little bit more. But then its next leg up from its low eventually went up 200%. And the other markets that I mentioned, the S&P 500 in the 1930s and housing, the second leg up that they had after the long correction and consolidation was at least 100%. And so, and with respect to the gold stocks, I mean, they're really following this pattern very closely. They had a really strong rebound, and they've been correcting and consolidating now for, I think we're in the 17th month. We're not quite in the 18th month yet. And with respect to, okay, well, when will this consolidation or correction end? I mean, the consolidation could continue for, 3 or 4 or 5 more months. I mean, I don't know. Maybe it continues for 1 more month. But getting back to your original point about there being a lack of sellers, even though you look at these charts, and I've been kind of fooled by this at some point in the last couple months, where you look at the charts and maybe they don't look that strong, or they kind of look a little bit bearish. But when you're studying history and you're assessing that, you have to understand that after you have a mega bear market, there's not that many sellers left. Okay, and then there's a sharp rebound, but then there's a correction or consolidation that lasts at least 18 months. I mean, there's just not that many sellers left to drive this market lower. And I mean, Corey, just look at GDX, for example. I mean, it had the bottom around 18 at the end of 2016. And then in 2017, 4 times it tested 21. And, we had this really strong rebound in the last 2 or 3 weeks or so. And just the strength of that rebound is telling you there's just not that much selling power left. And I mean, that doesn't mean that the market's about to explode higher in the next month or two, but there's just not enough sellers left to drive this market that much lower. And I think the December low that we've made in gold and the miners, I just think more likely than not, it's going to prove to be a higher low, and it's just going to lead to probably a really good year. We're not seeing that much selling power left, and that's going to bode very favorably, I think, throughout this year. And I mean, just one example today. I mean, you saw, the Fed, they had their comments, which I guess were perceived as negative for precious metals. I mean, despite the miners having had this fantastic rise over the last 12 or 13 days, they sold off on the Fed comments, but then the weakness was quickly bought. I mean, they were still down for the day, but the weakness was quickly bought, despite them already being up 12 or 13 days. So there's just very little selling power left in this market. And we have to, I have to remember that moving forward this year, as we study the technicals.
Yeah, it was interesting to see that all of a sudden drop in a lot of the stocks and even in the metals price, but it bounced back very quickly. And one other thing that you mentioned there that we've been trying to harp on throughout 2017 for how slow of a year it was, just look at the longer term charts and understand that we are consistently putting in higher lows, and that is encouraging. Yes, we haven't been able to break out, and hopefully that breakout comes sooner rather than later, but hey, it still might take some time. Either way, this chart for gold and the gold miners is still in a bullish side. It might not be screaming higher, but some of the other maybe background fundamentals, if inflation gets going and if truly all the sellers are dried up, then it truly is a market that continue to buy the dips and take your time to build your positions because, hey, it still might take some time, but again, a very constructive pattern and a very constructive market so far, and especially the way that we're starting this year. Jordan, great having you on the show. Everybody go check out Jordan's site and his posting. And Jordan, have a great rest of your day.